Good morning, everybody, and welcome back to Boutiques on Wednesdays. And thank you, Olga, for that very lovely upbeat music in these dark times. Excuse that pun. A year ago, we spoke about inflation, and the buzzword was transitory. And now we're talking about inflation, and it's sticky. So inflation, we know inflation remains with us and will probably remain with us for the next few years. When will the Fed pivot is all data dependent, the new buzzword in the market. Then again, normally if a Fed pivots, it's because of a recession. So maybe not a good thing. Slower global growth is expected, but to what extent will this impact on forward earnings and ultimately equity prices? The US labor market appears to be resilient, supporting prices for now, but that is not good for inflation. And we know that the Fed is fighting the labor market. But what about SA? Load shedding is shackling growth on multiple levels. That impacts on those markets ultimately. Energy and food prices, as you know, is a big part of inflation basket. Can energy prices stay lower for longer, with food inflation still a concern and may stay higher for longer as well? Then there's so much talk about China reopening and how this is going to support emerging markets, including countries like South Africa. Or will this cause a positive demand shock and inflation resumes an upward trend? Good morning to all again, and welcome Evan Walker from 361 Asset Management this morning. Evan, thank you so much for your time this morning. It's always a great pleasure to have you with us. Despite 2022 being an absolutely tough year, you still managed to give clients really good returns, all given. And congratulations on your Rating Buller nominees for your equity fund. Always right up there, and it does show in your performances year after year. It's going to be very interesting to see what your views are on how things come together in your SA Equity Fund, given all these very challenging decisions that may lie ahead for 2023.
Yeah, thanks, Eugene, and welcome everyone, and a happy new year to us all on our second Boutiques on Wednesdays, and a big thank you to BCI and the team for hosting us. Eugene, I think you did most of my presentation in the intro. I don't think there's much left for me to say. Barring that, I think we're in for an exciting year with a lot that's going to happen, and we're going to need to be at the front end of that. Thanks for the introduction. Just quickly to kick off, we're just going to show you our performances for last year. Our equity fund, slight underperformance relative to the market, but just to bear in mind that we have now transitioned that fund, the equity fund, from 25% offshore to 45%. So we used strength in the rand last year. We used a tough market, and we certainly have positioned that fund now on what we think is a 5-year view, and we very close to the 45% threshold on that fund now in the equity fund. On the SA Equity Fund, we all know that's a 95% investable fund in South African JSE, and we had a great year, Eugene, on that side, beating the market significantly, and we're proud of those achievements. Likewise, we're proud of all our underlying achievements in our flexible funds, and our hedge funds, which did exceptionally well last year in what we know was a tough year. So, just to move on, I mean, we can just now chat about what we think the macro factors are, what's influenced markets. We've had a frenetic start to the year, Eugene. We've seen the Aussie up just over 10%, MSCI emerging markets up 8.5% in dollar terms already for the year. I really feel like we've had 90% of our returns in the first 3 weeks, and portfolio managers can go to cash and take the rest of the year off. But that's not what's going to happen, Eugene. Unfortunately, we got to find another 11.5 months of opportunity set for us in the market, and it's certainly going to be quite challenging. I mean, what we did see globally, and this is just the backdrop, as we saw into COVID, this frenetic consumption from developed markets, especially the US and other parts of developed markets in Europe, as consumption just went ballistic, driving inflation. We thought originally it would be transitory. We didn't expect the amount of labor shocks to hit the market. I mean, that was an unknown, and I think most central banks around the world didn't expect that as well. They thought there'd be a consumption splurge, but didn't really see the second round effects of that coming through, and we're living with those currently. On the other side of the equation, the second biggest economy, namely China, had significant underperformance on the retail side and consumption side, as they really just sat put for 3 years, struggled with COVID, had significant lockdowns, which we saw through the period of last year, and then quite a sizable pivot, which came after some significant riots at the end of last year. We saw the Chinese government pivot extensively out of their lockdown policies, which threw the market and obviously saw the significant rally that we saw. What we did see was this, and what drives the market significantly in China, and this is obviously the Hang Seng, the Hong Kong Property Index, which is a proxy. Now, we've seen 5 years now of significant underperformance from the Hang Seng. We saw in 2020 policy from the Chinese government called the 3 red lines, which was basically liquidity constraints placed on developers in the market, which obviously saw a continual fallout. This index has rebounded 50% in the last 3 months as the Chinese government looks to be coming on board now and relaxing a lot of these liquidity constraints, which obviously hampered these developers in what is a very competitive market. I mean, there was over $85 billion of defaults last year from these developers. 47 developers in Hong Kong defaulted on their bond repayments last year, and a total of $1.3 trillion was wiped out, a cumulative across bonds, equities, and bank losses in the Chinese sector, as this property index obviously fell and needed to be recapitalized and still in the process. We think it's been a little bit too much too soon. We've had quite a negative view on iron ore across the market, just given the extent of oversupply in the Chinese market. We think the likes of the BHPs, etc., have rallied too hard. We haven't had big exposure there. Unfortunately, it's done significantly well at the start of the year. But again, we're still nervous on the outlook for iron ore the latter part of this year as this begins to normalize, and we think the start's a bit frenetic. On the other side of the pond, these European gas prices, which were killing the consumer in Europe, came back significantly in what was a much warmer winter than anticipated across the Eurozone. Prices fell significantly, driving down long-term consumption fears in the UK and the Eurozone, and that also helped really push these markets towards the latter part of last year, specifically November, and then again into January this year, as we saw the advent of a significantly warmer winter across Europe. I think the jury's still out on this. I think these prices have come back a lot now. I think we're still going to see colder patches. There's obviously the demand side of the equation for gas has come back significantly, but at some point we need to see Chinese come back online, European companies come back online as China opens up, because they're interrelated. No country stands in isolation anymore, and we potentially could see a little bit more spike on the inflation front as the European gas prices start to tick up. On the US demand side, it's coming down, Eugene. It's coming down quite fast. We know that. The inflation side is obviously falling. The indicators are slowing. It's good and bad. Obviously, there's still the recessionary worries out there, but all indicators now are pretty negative on the consumption side. The services side, still pretty robust, Eugene, but we watch these demand factors all the time. But at this point, still, inflation looks quite elevated, and we need to watch that quite carefully. You can see, as you mentioned earlier in your introduction, Eugene, obviously, coming down, wages still sticky, employment index, this is obviously CPI, and where we're coming. So, inflation has pivoted, it is coming down. The true extent now will really be, what happens by mid-year into the latter part of the year. What does oil do? It's rebounded off its lows. We still think there's a structural underpin to oil in the market as China opens. So we're certainly not out of the worry zone yet in terms of inflation in the US, but structurally consumption is coming down, and we have seen a moderation in this inflation index, which was obviously very, very prolonged through the latter course of 21 into 22. That just gives you a sense of the labor market. Still strong. This is new jobs advertised in the labor market. It's still highly elevated. But as we've all seen now, the retrenchments coming through from the Facebooks, the Googles, the Microsofts, etc., from the tech side, which obviously went out extensively and employed people through the COVID splurge, is coming down, and we're seeing it through a number of other sectors. But services per se still highly elevated, and still this first world dynamic that I don't think we've quite got our heads around yet, about the shortage of labor skills across the market. I've just recently come back from visiting my children in Australia and New Zealand, and there again, there's just huge shortages in labor. It just cannot hire people, massive constrictions across the Eurozone in certain sectors, and across the US, as a lot of people left the labor force through the start of COVID. and haven't resumed and come back to work yet. Guys, on the China side, I mean, this is the big be all and end all. It's, you know, the housing and China property sector is 25% of the global iron ore market. It's massive. New housing starts still continues to fall, but for once now we've started to see, you know, land sales picking up. I think there's been a lot of discounting from the municipalities and a lot of additional loans thrown at us in terms of stimulating the front end of this market and trying to rebound it. It's still hard to see if this is really sustainable given the amount of capacity that's in the market, the amount of properties that are still being advertised for sale in that Chinese market. But we know there's still, you know, 20 to 25 million homes that have to be completed. There's still an underpin for resources. It's just whether we structurally into a new cycle of growth, which we'll see come through during the middle to latter part of this year. The hope at the moment is that the Chinese will throw quite a bit at infrastructure. We've seen quite a big rebound in infrastructure, and that they can tap a lot quicker than the property market, which is way more reliant on private sector capital coming in and a recapitalization of that property sector per se, which has really done quite badly. We're still very exposed to the likes of the copper plays, the Glencores, etc., in our portfolios, as we think that's the preferential end to play as infrastructure comes through, but still supportive if this infrastructure manifests itself and property comes back of our resource prices, our rand, and certainly the outlook for the next 3 to 6, I don't think is I think that's pretty much in the bag. It's further on down the line if we can see this property sector coming back, given this big downturn in sales. Chinese total social financing, which has always been an indicator for us of the extent of growth in the market and a front-end lead indicator for what we're seeing, and the extent of that is still pretty benign. The appetite for credit, and given that a lot of people have been in lockdown, is understandable. I think the jury's out now in the next quarter or two to see just where this money gets spent, the appetite for total social financing, whether it comes back. We know the municipalities are drawing down quite fast to stimulate infrastructure, but it's just the extent of that given the decline that we've seen through most of last year and the year before. That's just another indication of the credit impulse in China. It gives you a sense that when they cut rates last year and they obviously released capital requirements, you saw obviously the credit impulse, which is the amount of capital or the amount of cash flowing through the system, rebound quite fastly. But unfortunately that has turned off, but there was draconian lockdown messages and we need to see that turn up again. So jury's still out as to the sustainability of this rebound. It's not 100% confirmed for us yet, but certainly the prospects are there, and there's obviously stimulation, and the Chinese consumer, as we know, will spend. It's just the interrelationship now on a global basis, whether they'll decouple from the rest of the world, how strong Europe will come back and the US will be affected, and whether a translation effect will hold them in positive GDP territory for the balance of the year. Jumping to South Africa, guys, we all know this load shedding crisis. It really did manifest itself through December into January. We've listened to numerous Eskom presentations now. I think that we're in the sort of crux of the biggest problem currently. It seems to me that they did spend a lot of time fixing old power stations and trying to renew some generating capacity through December into January for the start of the year. So that seems to have been the worst of the worst, but we know we're in for load shedding 2 to 4, okay, for the next 18 months. There is 9,000 megawatts of capacity coming online at NERSA currently. It's just when this comes online. It's hard not to be negative South Africa at this point in the junction. But again, I think what we're going to see is a lot of corporate spending, a lot of money, okay, in terms of obviously reconfiguring their businesses. I think it's going to be tough for SA industrials in the course of this year, obviously to get these, obviously spending money on diesel generation, but obviously adapting their businesses to a 2 to 4 scenario and potentially a 6 scenario through winter again. We know Coburg comes back online June, July, but then shuts down August again for the second repair schedule on Coburg. So a little bit of relief into the winter months, but certainly demand destruction has been there. and in South Africa, and it's really not good for our economy. But a sense is we've had the worst of the worst, and we're into the 2 to 4, but we are going to bumble along now, and I think the front end is really going to spear, a lot of growth on the renewable side in South Africa. We know there's 9,000. We're not completely negative SA. We still think you need to own these South African banks, which are going to benefit from a lot of corporates taking on credit to obviously spearhead the growth, and it does come. Now, all bad things, one good thing comes of it, and certainly I think within the next 3 years, a lot of corporates are going to have to be self-sufficient in this SA market. What it is doing now, unfortunately, is it's driving food inflation higher. You can just see there, it's a good slide to, I don't think it's any preferential place to shop, but food inflation is going higher. It's not good from that perspective for the lower end of the market in South Africa. Certainly cost of food and distribution, and it's going to be passed on, and this diesel cost is going to be passed on to the consumer. It's going to have negative impacts on other sides of consumption, which we've got to be aware of in the portfolios and make sure we're not exposed to those. We have got food exposure through ShopRite, Spars, etc. Very little apparel exposure. We've actually done quite nicely with it, and the retailers didn't trade as badly as we thought to this last period with updates. But certainly as the pressure mounts during the course of the year, we've got to be more circumspect around it. But then again, guys, we haven't got a very negative outlook on inflation in South Africa. We think the rand will depreciate from here as the inflation differentials change over the course of this year versus us versus developed markets. But again, we think there's going to be muted demand in South Africa and relative muted inflation, mainly in the food basket component and obviously electricity basket component of your consumption. So guys, just summary of the local views. We've spoken about load shedding, very costly for South African businesses. We've seen the likes of the large multinationals already. Ford specifically is fully up to speed with renewables, mainly solar. Toyota still has to do it. We think these guys are going to invest quite heavily, funny enough, in South Africa. So as I said, at the forefront, it's very negative, but I think all these multinationals are either going to pull out, or I don't think they will. Their supply chains are fully focused, and they're obviously looking at their globalization formats around the world in height of what we saw coming out of COVID. So I think a lot of these large multinationals, funny enough, are going to invest more in South Africa from a renewables perspective and look to take on debt, and our banking sector will benefit from that as we see these guys get to full speed. As I said, Ford already is at 100% of its electricity capacity. It can be done. On the mining side, I think we're going to suffer. The mines are only 10 to 15% currently. They're rolling out quite aggressively, but they're the big consumers of electricity in this country, and that's going to be hard hitting on our numbers, our terms of trade, and obviously our fiscus and the tax collections going forward. The big worry is social unrest. We've seen some of it spearhead itself in Klerksdorp and other areas which have been hit hard, and we know the municipalities owe Eskom 65 billion rand in unpaid arrear electricity bills. I don't know if Eskom can ever collect that, but these are problematic areas which also drive concerns around the SA economy, fueling a reduction in tourism, etc. So guys, the outlook, we don't expect an inflation blowout on the South African side, given very muted demand functions. As we said, we think it's all concentrated in the lower end of the market in terms of food and food prices, which are going to be hit hard, but that does come with some concerns. And obviously, further down the line, tax concerns to us, as a lot of our corporates have to reinvest in spending, operational profits on diesel, etc., will hit the tax line quite significantly for the next 12 months. And I think the next 12 months budget is going to be more concerning around potential fiscal disappointments in the South African market. And longer term, that's something we have to watch quite carefully and be concerned about from our bond exposure, especially in our flexible funds where we're currently neutral. Guys, just on the conclusion on the macro outlook for China, a very quick pivot. I think it took the market by surprise. We had a lot of negativity into the Chinese conference, the Communist Conference, a lot of negativity around that. We certainly had a lot of negativity around, their policies in China over the last 2 years. I think a lot of that has dissipated after the riots. I think the Chinese government potentially may have woken up. We're not sure. in terms of the risks and the event on the Chinese economy. They could see things getting worse. They have sided with Russia, which I think is a long-term problem from a global supply chain perspective. And we've seen a lot of US corporates already reprofiling their supply bases back to the US. I think that's good in terms of long-term growth perspective, but it does come with higher levels of inflation across the globe for slightly longer. And as we've spoken about, labor shortages are still very prevalent around the world. In the US, growth has been strong, guys. It's been strong. It's been highly elevated. It's been supported by labor. And it's also been supported by quite a significant depletion in savings now. So that's something we're watching quite carefully. Our base case is we're still in for a very muted recession in the US. We don't see massive scares around a huge negativity, but that's in terms of actual GDP numbers. Markets are still elevated, at 4,000 on the S&P now. We're still close to 18, 19 times forward with earnings we still think coming down for this year. So, we still think it's going to be a challenging environment, a very value-focused environment still in our portfolios, which we'll take you through in a couple of minutes. We're still very value-orientated in the portfolios. That includes, obviously, our equity portfolio, which has 45% offshore, favoring quite a high yield, dividend yield underpin to support valuations, and then steering away from high growth scenarios for now and looking to pivot back in that once we see definitive signs of labor coming back in the US market. Headline inflation we've spoken about is falling. The demand for services is still high in the US. And then again, the Fed pivot. I mean, what signal will that render? As you likely said, Eugene, at the onset, will that signal a big recession? We don't think so. The labor market's strong. There's a structural underpin to the growth in the US, given a lot of onshoring back into the market. And obviously, social and demographic drives around the market, around labor. But obviously, it's all around just how sticky this inflation sits and how long it takes the Fed to pivot and get inflation back to that 2% target where we're way off. So guys, markets are expensive. We've had a frenetic start to the year. We're trying to protect as much capital as we can. We've got a good job in parts. Our equity fund is way more conservative, where it can hold up to 20% cash, and it's holding a lot of dollar cash. Potentially too conservative through last year, as we saw some slight underperformance, but that's always good. We've had a very good start to the year, and we have moved to that 45% level. On our SA equity side, we can jump forward, Jackie, going through the presentations. On our SA equity side, we're sitting currently with approximately 61% of our fund in dollar, what we call dollar earnings. We don't like to call them all rand hedges. And then about 39% domestically, mostly in our banks and local institutions. But again, a lot of our industrial companies have dollar earnings in that 39%. So our full see-through value of the portfolio from an earnings perspective is around 30. So you could, and we're sitting with 5% cash. So if you look at a see-through value, we're probably at about 66, 70% of our portfolio in dollar earnings. As I said at the onset, we do think the rand will depreciate more significantly toward the latter half of the year as the inflation differentials. We've seen obviously developed markets have higher inflation than emerging markets. We think that'll start to rotate come third, fourth quarter and into 24. We think there'll be quite a significant rotation of that basis back to longer term fundamentals for emerging markets versus developed markets. And that inflation differential will obviously see the rand continue on its 5 to 7% decline. This year, more difficult to estimate given inflation differentials globally, but certainly if we take the long-term trend intact, and then opportunities in the SA market versus international, we're still favoring opportunities in the international over South Africa. We'll be sitting with a very value-focused portfolio. Besides our exposure to Naspers Process, which has done very well for us, the rest of the components of the portfolio are pretty high yielding and pretty supportive of still growth and yield return towards this part of the year. We still think, obviously, out of this negativity of load shedding comes growth. Strangely enough, we think the investment will come faster than we initially anticipated, given the sixes and what companies have to spend, and they're going to draw down on facilities at our banking institutions. There's obviously the worry of higher bad debts towards the latter part of the year as companies struggle to pay their diesel bills, etc. And that's something we're going to be watching quite carefully. But still, that's still our prize asset, very cheap in South Africa as our banking sector. And then we have got some smaller caps in the portfolio, which have some quite nice diversification away from Rand earnings, the likes of Grindrod, super groups, etc. And we're constantly looking to add. We've got the likes of Omnias, AECIs, etc. in the portfolio, which are not just pure South African businesses, which derive dollar earnings as well. Eugene, I'm not going to go through every single part of the portfolio. We're open to some questions. I think we're on time here with 5 minutes to go. The performances on the SA Equity Fund have been good. We're proud of those performances. We're certainly looking to compound off positive returns from last year into this year. We are conservative in nature at 361. We're trying to bank as much profit already in the first month of this year. We're looking for yield underpin. We're still looking for growth. We're looking for growth across sectors and small companies in the SA, as I said, and we do own sizable positions in small mid-cap companies where we think there's opportunity still in the South African environment that will obviously see the benefit and the transition over what will be a tough South African year in 23. And certainly as we get into 24, the hope of more renewables hitting the market, some stability in Eskom will be greatly rewarded by the market, and hopefully we can benefit and move that portfolio from, call it 70-30 dollar earnings to the reverse, Eugene. But for now, we're more comfortable with our current positioning in the portfolio and the growth prospects for those underlying businesses. Thank you, Eugene. I'm open to questions. I see I'm on time. I've just made it. And that gives us the opportunity to fire away. And I hope that was useful to the participants on the call.
Absolutely great. And thank you for that, Evan. You're absolutely spot on with time. A couple of questions from the audience and myself. Just very quickly, I mean, you mentioned that markets are expensive. And maybe my look at this is maybe too simplistic, but normally when the Fed pivots, it means that they are going into recession, but it seems that we're a long way off from that. Does it mean that there could be a lot more momentum in the equity market or legs in the equity market?
Yeah, Eugene, I think I think what we need to see in the next quarter or two is just whether globalization plays out or whether this Chinese economy is strong enough to resurrect the global economy out of slight doldrums. I mean, the translation between export imports, just Europe to China is a big component of global growth. Lower energy prices in Europe, look to be supportive for now, but obviously still a concern as we have cold weather. But I think structurally, the Europeans did a lot to ensure that they negated those high gas prices coming out of Russia. So that seems, a way better position than we anticipated, 6 months ago. The Germans, all these LNG vessels floating around, getting power into the Eurozone seems to be a bit more structural. The Chinese consumer has a lot of cash, 3 years of cash, and we saw what happened when the US had a lot of cash and have spent it. So we think there's a lot of underpin from the Chinese consumer. We obviously think there's going to be a lot of trade which is going to flow now. European companies are going to open up again and are not as nervous around their consumption levels of gas and energy as they would have been 6 months ago. So we do think that frees up a market. But again, Eugene, the delta on global interest rates for the consumer is high. We haven't had rates in this territory for, call it 15, 20 years. So we've got to be cautious, Eugene. I mean, we need to be cautious in our portfolios. We need to grow portfolios and have growth, but at the same time, we need to have big positions in high yielding stocks like the BTIs, etc., which offer protection in the portfolios, and still look, to obviously grow percentages over the while. So yeah, I mean, the next 2 quarters are pivotal. Okay, really from a Chinese growth perspective, what do we see? We're into the Chinese Lunar New Year now, the year of the rabbit. So let's hope we do bounce back, Eugene, and the Chinese do give us that impetus. But again, the world needs each other, and it's going to be a tougher year, and we're anticipating a tougher year. It's been a frenetic start, and we want to ensure that we can obviously bank some of that and hold some of that in reserve, and obviously find continued opportunities in the market where we don't think it's all fall down, as we've always said.
Evan, you spoke a lot about inflation differentials changing over time, and it's very difficult to call any sort of currency in the short term. But currency is always top of mind for a lot of investors out there. And I mean, if you look at simple PPP graphs, then the rand is still too weak and the dollar is still too strong. But with China reopening, and you spoke a lot about that, could that in the short term mean that we'll see a softer dollar until those inflation differentials change again?
Yeah, Eugene, I think there's no doubt that we've got this year still with developed markets at higher inflation than emerging markets. I mean, I'm talking emerging markets that encapsulates China, where inflation is low. So, China needs to come back. Unfortunately, that might drive up oil prices and start throwing us in a bit of a reverse spiral. So there might be a feed-through loop on that we've got to be aware of, specifically with offshore allocations. But again, I think if you look over the longer term now, we never thought we'd have developed markets ever showing us. I mean, German PPI, Eugene, was up at 42% last year on this gas thing. And, we haven't seen that since World War II. So, I mean, these were big numbers. They're coming down fast. And then into the latter part, if China's inflation starts to come back a little bit on consumption with higher oil, we'll start to see a reversal. And generally over time, currencies trade with those inflation differentials and narrow them. That doesn't work in the short term, but over the long term it does. So I would suggest by mid-24, as I said, I think there's enough activity in that Chinese market currently. There's enough completion of homes. There's still 20 to 25 million homes that have to be completed, number one. We've seen land sales resurrect. We're not big bulls on that Chinese property market because it's a very mature market. But we know there's still a lot of completion and the Chinese are putting big liquidity in. That's still going to support commodities for now, 6-12 months. It's still on a relative basis. And certainly will still have a good terms of trade for us. Over and above that, further out, if this Chinese consumer overspends, and they're quite conservative, Eugene, we've never seen that in the past, but they are more frenetic now. They are traveling more, etc., but not necessarily so much in their own home countries do they spend. They do spend on luxury, etc., but they're not big spenders. But whether they come back and frenetically spend, we're going to have to watch still, because retail sales have been very muted there. But again, I emphasize that I think by this time next year, inflation differentials will be looking a little different. Certainly for an emerging market complex per se, it's all regional. As we know, South Africa's got its own issues. Everyone's got its own issues per se, but just as in a nutshell, I would say that by this time next year, we're going to be looking at inflation differentials that are considerably different to what they look like now.
Agree with you on that. Naspers big exposure chunky in your SA equity fund. I think if I remember right, 13%. Question from Dean as well. What is your earnings expectations from Naspers at these elevated PE levels?
Yeah, so I mean, I've been pretty negative 10 cent on it. I mean, we did obviously see 10 cent sell off. I mean, it obviously got smashed down to below 250 Hong Kong dollars. I think at the results, what inspired me is not so much the earnings out of 10 cent, which I think reporting now in February, March will be pretty muted off last year. So I think the market's looking forward. But I think in 10 cents cases, their capital discipline is starting to, they're obviously starting to unbundle now and distribute companies out, putting them on, 3 to 4% dividend yields as they get rid of underlying holdings, which they shouldn't have had in the first place. They should have reinvested back and bought their own shares back. But be it as it may, they are distributing out sizable chunks of underlying capital in businesses now, which should over time drive up their returns in those businesses. They have got a few more games online. Obviously, they're very reliant on activity in the Chinese market from an advertising perspective, from a cloud perspective. They're an IT services business per se that relies on Chinese GDP coming back. So the market's already priced in quite a bit there. On the process Naspers side, there's obviously the ongoing buyback to drive up the further NAV valuation of that and bring down the discount, which has narrowed quite significantly. And I think that underlying motive has been there. It's not cheap currently. I think that, we've got back to more than fair value on 10 cent. But again, I think that market's going to stay pretty elevated for now while we look to see what that consumer does. We've taken a bit of profit already in that sector during the course of this year. We started taking some profits on that as it's had quite a nice rebound and reposition more structurally. And as as we think it gets more expensive, we've been pretty good over time of taking profits and reallocating to more valuation. So that's been in the SA equity space, that really has been our growth play. Fortunately, we've got it right, and we bought back quite a bit. We didn't always get it right, but certainly for me, the 10-cent capital allocation part of the business looks better. We just need to see, obviously, a better operational result come out of 10-cent over the next couple of quarters.
Evan, thanks for that. Two more questions very quickly. We're running very much out of time. You mentioned in your the 361 BCI equity funds, that's one that's got the global exposure as well. And did I mention that the fund is nominated for Raging Bull Award? But in that fund, you mentioned that your global exposure increased to 45%. Is that going to dollar cash, or what are you buying?
Eugene, we structurally across the board allocating money to long-term growth drivers that we think are pretty intact. We still like global financials. We've got quite a big slug of global financials, European banks trading on 7-8% dividend yields, even some UK banks, some US banks in that portfolio. We did very well last year, adding some of the defense stock names, the Lockheeds, etc., into that portfolio, which did nicely, where I think they're structurally underpinned. We have some resource companies in there as well, some copper plays like Freeport, etc. We've bought back into some of the global telecommunication plays on high yield as well, 7-8%, Orange, Verizon, etc. And even there, we've bought back a couple of growth names, etc. So we structurally have set ourselves 6 to 7 sectors of the market that we think have structurally good valuation and growth prospects, whether it's from a renewable sector. We've taken up a small position so far in VW on the mobility side. It's trading on 4 or 5 times earnings. So we've structurally looked at every sector of the market, the valuation opportunities across the globe, where we think we can play. We've got a very value-focused orientation, as I said, currently in the portfolios, looking for high yield this year, but also looking to pivot back to some growth if there's opportunities there. We've pivoted back to small components of healthcare and semiconductors, but quite small in the overall picture there. But certainly just looking for long-term growth opportunities in what we think will still be a tough year. We've got to be realistic. As I said, the delta on interest rates is still going to mean the consumer's under pressure, and we've got to understand that. And valuations are still high, so very much a value-oriented portfolio. We are sitting, Eugene, with, for the first time in a long time, a lot of dollar bonds in SA corporates and international corporates yielding us 10-12%. First time ever for going for 11 years at 361, we've had quite big exposure to corporate dollar bonds in the equity fund, where we can take that up to 20% if we want to on our mandate. And we've still got quite a sizable portion of dollar cash at around 10-11%, which we can deploy. We've got euro cash, we've got and other opportunity cash. But looking for yield tick up. Don't let the money sit idle. Even if we're sitting on 3-6-month government treasuries just to give us some yield uplift, we're obviously looking to partake there all the time. But the mandate of that fund is we've always run it conservatively, maybe sometimes too conservatively, as we saw last year. We could have had more equity at points and we missed out. But overall, the track record of the fund has been a very low volatility fund, which has given returns that certainly have, as you said, rightly so, given us a Raging Bull nomination.
20-second answer. Your views on gold as a defensive asset?
I'm a bit of a gold bull. We didn't get this last little spurt in gold right. We had quite big exposure in the portfolios, though, to Anglo Gold, Goldfields. Mining Analyst has done a great job of keeping me bullish. I thought they were too expensive. We stayed with those stocks through the last quarter. I still think in a world of turmoil, in a world where currencies, Eugene, we argue the dollar's too expensive, and the fundamentals are weak, but then find me a country where the fundamentals are strong. I mean, it's where would you rather park your money, in the US taxpayer or in the Japanese taxpayer? Now, I'm not quite sure. They all look bad to me at this point in the juncture. I mean, I suppose I've just come back from New Zealand and Australia, and those don't actually look so bad on a relative basis anymore. Maybe we should park our money in New Zealand dollars for a little bit. That looks quite strong. But I'm just saying, it's a difficult differential to play, and in a backdrop of a world which has a lot of government debt, which has a lot of uncertainty, you've still got an asset with a structural shortage over the next 10 years. It's run hard gold back from the 1700s into the mid 1900s. I don't think I would be buying it here on any clawback, though. We're still long-term gold bulls.
So I gather you'd rather buy something like an Anglo as opposed to buying gold, bullion or ETF.
Oh, yes, because we get the gearing and those stocks have done incredibly well. And on a relative, our gold shares, compared to the global internationals, which trade on twice the ratings that we do, our stocks, our Goldfields, our Anglo Golds, etc., still look incredibly cheap and, still could be potentially taken out, from the big global players.
Very last question is the question that actually came in before we even started. Grey listing, a lot of talk on that again. Impact on SA's economy.
Sorry, just say the first part again, Eugene.
The grey listing, that looks more likely that we are going to be grey listed. Possible impact on SA economy and some of your holdings?
We've done quite a bit of work on this, and we've spoken to banks analysts in Dubai and other jurisdictions which were grey listed, and there was zero impact, Eugene. Absolutely zero impact. We think for some small funds, mainly asset management funds in the UK, which have got limited compliance options, there might be a marginal impact. But we've had some calls with people in Dubai, around the world, where there's been obviously grey listing impacts, and it's had zero impact on our banking, on their banking sectors. It's had zero impact on their capital flows. So I was quite nervous of this upfront, but having done the work, having spoken to a lot of our big international guys that are on our doorsteps here, the Morgan Stanleys, etc., that have done work in it for us, there doesn't seem to be any real risk around this grey listing per se, given what's happened in other jurisdictions.
Bigger issue for South Africans if you want to take money out of the country if you were to be grey listed, because they're going to ask you a hell of a lot of questions or more questions.
Yeah.
Evan, thank you so much for that. It's been absolutely delightful, and thank you for the great work you've done on all your funds. To our audience out there, don't forget next week, Wednesday, 1 February, we've got Fairtree on the Select BCI Balance Fund, again, multi-asset high equity, and they're going to touch on things again like SA equity, global equity, and then asset allocation. What does it look like? Evan, again, to you and your team, thank you for the great work. Thank you for joining us this morning. To our audience, thank you for your continued support. And the BCI team, thank you for making all this possible. Tanya and Olga, great work you're doing. And we'll see you next week, Wednesday. Thank you so much.
Thank you, Eugene.